If you look at the climate science, the message is it's chillingly clear. The global energy transition needs immediate, massive, scalable action.
Absolutely.
But then you look at reality and you see the infrastructure required, those big energy mega projects, even the renewable ones. They can often take 10 years.
Or more.
10 years or more just to get from an idea to being operational. And that timeline, well, according to the sources we're diving into today, it pretty much guarantees failure.
The urgency is undeniable, and the scale is just staggering. I mean, the world currently consumes something like 40 billion barrels of oil and 140 trillion cubic feet of natural gas every year.
Wow.
And the challenge laid out in these documents is replacing all of that with sustainable alternatives. And doing it within a 50-year time frame, if we keep going at the current speed, will miss those goals by decades.
Yeah.
It's not even close.
And that's exactly the context for this GreenPlant Vision. It's not just a technology roadmap. It's a fundamental reimagining of how we finance and operate infrastructure, all designed to collapse that 10-year timeline down to maybe 3 to 5 years. It even has its own philosophy, which the source material calls Greenomics.
And Greenomics is the term for the entire economic architecture. It's the set of rules.
Right.
It defines how this new financial system would work, how you generate what they call patient capital, and how you verify environmental impact completely outside of the usual risk-averse markets.
Okay, so let's unpack this for you, the learner. Our mission today is to dive into the core, and I have to say highly unconventional mechanisms proposed in this source material.
They're very unconventional.
We're looking at a solution that proposes using everything from government monetary policy think, QE-style mechanisms, all the way to cryptocurrency.
Right.
All to build essential sustainable infrastructure, and the scope is enormous. We're talking green hydropower, next-gen nuclear, clean water desalination, carbon capture, the whole spectrum.
Before we jump into these bold new solutions, we really have to understand the depth of the problem they're trying to solve. The sources are pretty emphatic that our current approaches are, well, structurally designed to fail.
They are.
So what are the 3 fundamental barriers that GreenPlant says are stopping progress?
The documents clearly identify 3 core systemic issues. The first one is all about the money. Prohibitive financing requirements.
Okay.
Traditional project finance, it expects an extremely high and frankly unsustainable internal rate of return, the IRR.
And for our listener who might not be fluent in finance jargon, IRR is basically the profit rate you expect to make on the investment each year.
Exactly. And investors, they're typically demanding 12% to 20%.
Which is a lot for a huge long-term project. It's huge. And when you demand a 15% return on vital infrastructure, that high premium is just.
Yeah.
It's completely incompatible with the rapid, low-cost deployment we need for climate deadlines. That cost of capital, it kills the project before it even starts.
Because the energy would be too expensive or the risk is just too high for lenders.
Right. So that demand for short-term, high returns is the first wall.
Got it.
The second barrier is the protracted permitting and regulatory processes. The red tape. These delays can hold up a project for years, sometimes even a decade. You see it everywhere. It's not a lack of technology, it's a lack of regulatory speed.
And the third one?
The third issue is the conclusion that our conventional economic models themselves are just.
Yeah.
They're incompatible with the urgency and the sheer scale required for this global transition.
So here's where the proposal really gets interesting. The traditional model, it relies on classic project finance, right? A little bit of sponsor equity, a whole lot of commercial lending. And that structure is slow, it's risk averse, and it demands that high premium we talked about. So if that model is the foundation that guarantees failure, how does GreenPlant actually replace it?
It replaces it with what the sources call the dual pillar approach. This is the heart of Greenomics. This is how they plan to drive the cost of capital down to, well, virtually zero. So Pillar A is all about generating what they call government-backed patient capital. This is the core mechanism for front-loading the trillions needed.
Okay.
And it proposes the use of zero-coupon GreenPlant bonds.
Zero coupon, meaning no regular interest payments are made to the person holding the bond. You just get the principal back at the very end, at maturity. So the debt grows slowly.
That's correct. The issuer would be the central bank or the treasury, but here's the crucial point. The maturity is set at 100 years.
100 years.
100 years. That's double the typical estimated lifetime of the assets themselves, a wind farm, a nuclear reactor, whatever it is. This is generational financing.
Wow, a century of patience. That completely shifts the perspective, doesn't it? From maximizing short-term shareholder value to securing long-term national and climate security.
Exactly.
But how does the government find this money? Does it just move it from other budgets?
No, not according to the plan. The mechanism here is money creation, specifically through QE-style monetary policy.
Quantitative easing.
Right. This provides ultra-low-cost, patient capital, because the return requirement over 100 years is so minimal compared to commercial rates, that huge barrier of a 15–20% IRR, it just vanishes.
Right.
The government is essentially leveraging its sovereign balance sheet to create the credit needed.
Hold on, this feels like the critical juncture. We're talking about quantitative easing, which, a lot of people associate with flooding the market with liquidity. Doesn't funding trillions in infrastructure through money creation risk causing serious inflation, or just ballooning sovereign debt to dangerous levels?
That's the major criticism, and it's one the sources try to address. They emphasize the purpose and the structure of the debt.
How so?
Well, first, the bonds are tied specifically to real high-value revenue-generating assets, the green plants themselves. This isn't just money for money's sake. Second, there's a supplementary tranche, inflation-linked perpetual bonds.
Okay.
These are designed for specific projects, and they offer the bondholders inflation protection. It's meant to preserve the long-term value against currency depreciation. The argument is that funding vital deflationary infrastructure like cheap energy actually offsets the inflationary risk of the money creation itself.
Interesting. So that covers the capital side. What about Pillar B, the decentralized part, GreenCoin and democratic investment? If the government is funding the whole build, how does the public get involved? And why bring crypto into this?
This is where GreenCoin comes in, and the whole framework of Greenomics. It defines the logic for how that currency is issued, circulated, and then redeemed.
And it's tied to what exactly?
It's tied directly to verified environmental impact and the successful returns of the green plant business. This is the mechanism for public participation and, for the government, partial cost recovery.
But how do you verify environmental impact in a way that gives a cryptocurrency actual value?
So once a project is built and it's operational, the government can sell up to 49% of the equity in that project, or even more. And they do it using GreenCoin and/or these green NFT tokens.
And the value comes from?
The value comes from the fact that your token is backed by a real equity stake in a brand new, essential revenue-generating asset. And the coin's issuance is linked to verifiable milestones like CO2 removal or kilowatt hours of clean energy produced. You're turning the climate solution into a tradable asset that anyone can invest in.
So this is how the public gets democratic access to, multi-trillion-dollar infrastructure projects while letting the government recycle some of that initial bond money.
Exactly.
But this level of centralized control, this unconventional financing, it requires a massive shift in governance. How does the model manage the project lifecycle legally and operationally to actually hit that 3 to 5 year timeline?
The operational blueprint is designed to just strip out time and cost wherever it can. It's all laid out in their 10 core principles. First, every single project starts as a green plant special purpose entity, an SPE.
A separate company, basically.
A separate company with 100% government shareholding during the development phase. It's completely ring-fenced and controlled by the state during that riskiest, slowest part of the process.
And what about those regulatory hurdles? You mentioned the protracted permitting, the Achilles heel that causes the 10-year delay.
That's where the emergency legislative framework comes in.
Yeah.
And this is probably the most politically profound requirement of the whole plan.
Okay.
The government has to mandate expedited green plant legislation. This would include accelerated land acquisition procedures, using eminent domain powers if they have to, and radically streamlined permitting.
And to speed it up even more.
To collapse the timeline, the sources specifically mention temporary construction emissions exemptions, just for green plant projects, prioritizing the speed of renewable deployment over short-term emissions from construction. The government also provides support like zero-cost, long-term land leases to the SPE.
That is a staggering political commitment. It means treating climate action like a true existential emergency, overriding normal checks and balances to get land and permits fast.
It does.
So what about cost control? Because if the government is funding it, the private contractors, the builders, the engineers, they still need an incentive, but without that high-risk premium.
That's managed through the operations and maintenance service structure, the OMS, and a concept called cost plus fixed profit, or CPFP.
CPFP.
So the SPE owns the assets, but the OMS operates them under this CPFP arrangement. In a traditional contract, if a project runs into trouble, the contractor absorbs the loss, right? Which means they pad the initial bid with massive risk premium.
Right, they bid high because they expect things to go wrong.
Under CPSP, that whole incentive structure is inverted. The profit margin is capped very, very tightly, at 5% or less. The contractor gets paid their verified costs, plus that small fixed profit,
Regardless of what goes wrong.
regardless of unforeseen difficulties. This eliminates their need to bake in that huge financial risk premium. They're incentivized to be efficient partners, not adversaries trying to squeeze out more margin.
A 5% profit cap, that radically changes who is bearing the risk.
It does. And to make that 5% margin work for the operator, the OMS, which is structured as an LLC, gets huge legislative support. We're talking 95% profit payout relief and exemptions on VAT and import duties.
So it dramatically lowers their cost of doing business.
Exactly. Makes that small fixed profit margin suddenly very attractive for the private sector operator.
And this CPFP model, it extends to the entire build process, not just the operations.
Yes, through what they call alliance agreements. Instead of a chain of adversarial contracts, they use collaborative alliance agreements across the whole life cycle. Every single contractor and supplier operates under that same cost-plus fixed profit mandate.
Which gives them long-term certainty.
Long-term certainty reduces overall risk premiums and lets them use those valuable tax and import duty exemptions. The sources claim this lowers total project costs by a really significant margin.
Okay, so we have the government funding the asset build with a 100-year debt. We have private companies building and running it for a guaranteed 5% profit. What does this all mean for the return on that initial investment? If the government issued these huge bonds, how is the public's money ever recovered?
That's handled by the profit recycling mechanism. Remember, these assets generate revenue from selling energy or water or whatever. All the profits the SPP makes that are over and above that 5% threshold for the O&M service, they go directly back to the government treasury. This huge stream of funds is then used to buy back the bonds or to finance the next wave of GreenPlant projects. It creates a self-reinforcing financing cycle. The infrastructure basically pays for itself back into the public purse over the long term.
The source material suggests this model isn't just for, solar and wind. It seems to be proposing a total infrastructure overhaul. Can you just quickly list the scope of the technology this Greenomics structure is meant to cover?
It is comprehensive and it's integrated. It includes all forms of solar and wind, sustainable biofuels and HISAF, green and blue hydrogen production, hydroelectric power.
And then the more controversial ones.
Yes, next generation nuclear power,
Yeah.
specifically SMRs and other advanced designs. Then there's clean water production and desalination, carbon capture and storage, or CCUS, and of course, large-scale energy storage systems. It's the full spectrum of what we need.
It's just such a sharp contrast to the slow, incremental, market-driven approach we see today. If we were to summarize, what are the key claims of innovation that GreenPlant brings to the table?
The sources claim they achieve what they call a new paradigm. I think the most compelling claims are, first, the timeline acceleration collapsing that 10-plus year cycle down to an accelerated 3 to 5 years.
Right.
Second, replacing the traditional 12 to 20% IRR requirement with this patient capital that has minimal return expectations. And the big economic benefit, they state, is the elimination of financial risk premiums, which they project reduces total project costs by a massive 30 to 40%.
And it's important to remember that 30–40% cost reduction is a direct result of combining the 100-year bonds with that mandatory 5% CPFP contractor cap. You eliminate high-cost commercial debt and inflated risk premiums at the same time.
Precisely.
Yeah.
And if we connect this to the bigger picture, the source outlines a very clear 4-phase implementation pathway. It starts with emergency legislation in year 1, moves through pilot projects in years 1 to 3, and then scales up nationwide in years 3 to 10.
That's an aggressive schedule.
Very. And it all hinges on the risk mitigations being sound.
A project of this scope, built this quickly, it's inherently risky. What stands out to you about the proposed risk mitigation strategies in the sources? How do they protect this massive public investment?
Well, they seem to mitigate the sovereign and long-term risks pretty effectively. The inflation protection is built in with those perpetual bonds. Technology risk is mitigated through mandatory diversification. You're not putting all your eggs in one unproven entity basket.
Makes sense.
And most importantly, the foundational government backing completely eliminates refinancing and demand risks. Since the government is the ultimate backer and the client, the risk of the project failing to find financing or customers, it's just removed from the equation.
So we've looked at Greenomics, A comprehensive plan that merges governmental QE-style monetary policy with green tech development, forced collaborative contracting, and equity sales through cryptocurrency. It is a radical alternative.
It is.
An alternative to the conventional approaches that the source material claims just guarantee failure because they're too slow and too expensive to meet our climate deadlines.
The GreenPlant Vision fundamentally reframes how we build infrastructure. It relies on a foundational shift towards government acting on an emergency basis and using non-traditional finance, those 100-year bonds and GreenCoin sales, to meet what are, non-negotiable deadlines.
It shifts the burden of risk.
Completely. It shifts the burden of risk and high capital cost away from volatile commercial markets and places it onto the patient sovereign balance sheet.
And that operational efficiency, achieved by forcing everyone to collaborate through that cost-plus fixed profit model, capped at 5%, that seems to be the engine for hitting that dramatic 3 to 5 year timeline.
Absolutely. It's a systemic solution. It addresses finance, regulation, and contracting all at the same time. And looking ahead, the four-phase plan culminates in phase 4, global expansion.
Right.
Exporting the model to partner nations. And this raises an important question for you, the learner, to consider. Given the absolute requirement for these highly specific emergency legislative frameworks, including accelerated land acquisition and sweeping regulatory exemptions, can a model that requires such deep and mandatory integration of government monetary policy and a highly controlled private sector, can that truly be adopted internationally by all sorts of different nations? Or does its success rely entirely on having one strong, sustained domestic political consensus? Something to mull over as you see how crucial infrastructure is built or delayed in the years to come.